All right, welcome today to Cover Your Assets, Protect Yourself with Insurance. We're going to be covering a little bit of every type of insurance, all the main ones that you can think of, but we have a lot to cover, so I'm going to go ahead and introduce myself. My name is Andrea Pellegrini, and I run the Student Money Management Center for the entire University of Illinois system, and we are joined today by Corbin McGee from the Illinois Department of Insurance. Corbin, do you want to talk to our audience and tell them a little bit about what you do at IDOI?
Yeah, thanks, Andrea. And hi, everybody. My name is Corbin McGee. I am the Deputy Director of Consumer Education and Protection at the Illinois Department of Insurance. I've been at the department for about a year and a half now, and the role I get to play is going out into the community, talking with all Illinoisans and making sure that they understand how their insurance works and also understand any gaps that may exist or common gaps that exist when we are covering ourselves with insurance. So excited to be here today and to chat through my favorite topics.
Thank you so much, Corbin. We're really blessed to have Corbin joining us as insurance can be a kind of difficult topic to cover. So collectively, the Get Savvy webinar team represents organizations across the state of Illinois, which rest on the land of multiple Native nations, which includes the ancestral lands of the Peoria, Kaskaskia, Piankashaw, Wea, Miami, Mascoutin, Ottawa, Sauk, Meskwaki, Kickapoo, Potawatomi, Ojibwe, and Chickasha nations. And we have a responsibility to acknowledge these Native nations and work with them towards a more vibrant and inclusive society. So we are going to have a lot of polls today, but I'm going to launch our first one around demographics to get to know kind of who is joining us, where you are in your life, how we need to modify what we talk about for examples today to better meet you where you are. So we just want to know kind of what your age range is, whether you're a student or full-time employee, what university that you're associated with, or how you heard about us through one of our partners, right? So once you get all of those kind of answered, make sure to hit the submit button. It looks like about 27% of you have participated so far, but we've got all kinds of ages that are with us today. We have mostly full-time employees, but lots of students too. It's really good to know. Lots of UIC and University of Illinois Urbana-Champaign folks, but we have people from other organizations or institutions as well. A lot of women on today, and it looks like we have a pretty diverse group. So if you can answer that and then we'll move on. We have about over half of you have participated so far. I'm not going to stay on here too long because we have too much to cover. So I'm going to go ahead and end the poll and share the results with you real quick so you can see who's joining us. And then I'll stop sharing. But if you still see a box, you can exit out of that box and the next poll that we pop up should still pop up for you. So our learning objectives today, we're going to review a few of the core financial risk management strategies. There's a lot out there, but we're going to focus on four. We're also going to define some key insurance terminology and how policies work generally. We're also going to talk about some common insurance coverage gaps, which Corbin already kind of alluded to in people's financial portfolios. We're also going to identify appropriate insurance strategies for different life stages, whether you're young or whether you're older or whether you're in a relationship or you have a whole family or you're solo. All of those different things kind of influence how you assess risk and what should be top of mind when you're thinking about your insurance coverage. And then we're also going to talk about some of the regulatory protections for consumers related to insurance and how to file a complaint if you run into that. Today's session is also for educational purposes only. We're here to help you understand kind of the general concepts related to insurance and financial risk management, but we cannot provide advice or recommendations for your personal situation. We also welcome a lot of participation in the chat. A lot of people learn better from others and you have valuable experience to share. However, please remember that everyone's needs are different and be sure to do your own research and evaluate what financial products or strategies are right for you in your specific situation. Any experiences or suggestions that other people are sharing in the chat should be taken as general information and not advice. So just keep that in mind. We don't want to discourage sharing, but we do want you to recognize that everyone's situation is different and it's hard to get a whole picture of your financial need from a comment or even a 1 hour webinar, right? So let's talk a little bit about life-wide financial planning. There's all these different components of financial planning that we participate in across our lives. For example, goal setting is a really important aspect of financial planning that we engage in routinely throughout our lives, and our goals change. It's something that we tend to focus on a lot in our other webinars, but it's a really big piece of creating any type of plan, financial or otherwise. Um, so, for example, retirement is not something that a lot of people, a lot of younger people in particular, focus on, but it is something that's important so we can take advantage of time, for example, if we're investing, or we can think about how our risks change as we get closer to retirement. Budgeting is a skill associated with financial planning, and that helps us accomplish the goals that we set. Risk management, which we're going to focus on mostly today, includes insurance planning, and that is what is focused on protecting your finances, your resources, your other assets against different types of risk. So when you're thinking about investing, this is what helps us build wealth, and you want to protect that wealth once you accumulate it. And we're really lucky that we have Corbin on to help us talk about protecting our assets and the things that we invest in to grow wealth today. So we talk more about life-wide financial planning in our estate planning webinar, which we will also link to with our follow-up webinar or follow-up email that we send to all the registrants after the webinar is over. All right, so I said we're going to have a lot of polls today, and so I'm going to launch a poll about how you feel about insurance. So what types of insurance are you most confident purchasing, using, and discussing? And what types of insurance are you least confident purchasing, using, and discussing? Just think about the top level ones. So we have a list in this poll of health insurance, life insurance, auto insurance, renter's home or condo insurance, travel insurance, maybe all of the above or none of the above. You're either confident or not confident with. All right, so it looks like about 30% of you have participated so far. There's a lot of people that feel most confident about auto insurance. And the second most confident is life insurance. And then the third most confident is health insurance. And there's a few of you that say, none, I don't feel confident in any of these. And then for least confident, a lot of people have listed renters, home, and condo insurance. Life insurance is a second, least confident in, and then all of the above. We don't know anything in travel insurance. It's good you're here today so that we can talk about all of these things. I am personally a little bit surprised how people feel least confident with renters, home, and condo insurance, but it's a good thing that we have Corbin here to talk about that. So I'll share real quick. Corbin, just your thoughts. Are you surprised by the responses we got?
I am. I think uh, the one that jumped out was the confidence around life insurance being the second most confident topic. And I feel like that's one that folks have a lot of questions around when I
Yeah.
go out in the field. So that one surprised me. And yeah, I think renters, home condo, I think I I think I assumed that health insurance would have been in like one of the top confidence ones, because it's one that we utilize a lot. But you know
Yeah.
what? It's interesting. This is such a personal experience, and everybody has used different types of insurance at different times. So you never know. You never know what you're going to see the confidence and the confusion around. So we'll talk
Yeah.
through all of these today. So stay tuned.
Thanks, Corbin. It's always good to know what other educators think about responses as well. So, if you were in the boat of I'm not confident with any of these, that's okay. There's a lot of Americans and people in the United States that have low insurance literacy in particular. But this study that's been done several times, it's a survey that's done, I think, every year, but a comparison between 2017 and 2025 on performance on the PFIN index, which is like 28 questions that go over different categories of financial planning, like borrowing, saving, consuming, earning, understanding informational sources, investing, insuring, and comprehending risk. In general, very few of us score above 60% accuracy on any of these categories. But in particular, with comprehending risk and insuring, we as Americans in particular don't do so hot with knowledge questions in those areas. So it's good that you're here to learn more so you can make more informed decisions, but know that you are not alone. It is very confusing for everyone. All right, so let's talk about understanding and assessing financial risk kind of globally or broadly, and then we'll get into the nuts and bolts of managing financial risk. So when we think about risk, we want to define it, right? So our assets, our potential, our lives, they all have value. And with that value comes a particular risk. A textbook definition of risk is the uncertainty regarding the occurrence of an event that could have a negative impact on objectives, assets, or safety. And so it can be measured in different ways, and that's kind of what makes it difficult to decide how to handle risk. So essentially, there are four core risk management strategies. You can avoid the risk, you can reduce the risk, you can transfer the risk, or you can accept the risk. There's other ones depending on what source you use to understand risk, but essentially, we're going to focus on these four. Avoiding the risk, this is where you remove the risk. So you go beyond just reducing or controlling the risk and you avoid it entirely. So, for example, maybe you sell your car and you use public transportation. So you risk of getting in a car, causing a car accident in particular, is zero. You are avoiding that risk. Reduce or control the risk, the reduction method is you reduce the likelihood of an event and or you take actions that would reduce the financial loss if the event occurred. For example, you wear seatbelts, which would reduce your injury in the event of an accident, and you do not speed, which reduces the likelihood of an accident, but that doesn't reduce your need for car insurance. Just keep that in mind. When you transfer the risk, you arrange for someone else to bear the financial responsibility for that event. So there's all kinds of ways to deal with this, but one other way related to auto insurance is you buy collision insurance on your car so that the insurance company bears the risk of having to replace or repair your car if you get into an accident. All right. And then acceptance is where you bear the risk. This is also called retaining or assuming the risk. Uh, so you bear the financial burden and do not actively seek to reduce the likelihood of the event or its financial severity. So, for example, you drop your collision insurance on your 10-year-old car and you continue to drive it regularly, and you assume if there's any damage done to your car, that you will pay for it out of pocket. It's also called self-insuring when you accept the risk. But we're going to be focusing on transferring that risk. So when you're transferring risk, you're taking the financial burden that would solely be on you if, for example, a tornado hit your house, and you transfer it to a group that is less likely to have a financially severe event like a tornado hitting everybody's house across the United States at the same time. So that is one example of how transferring risk through insurance works. You pay for the coverage in case an event happens, and it's a lower cost over a period of time than if you would have to save up just in case that particular risk happened to you. So when you're thinking about the cost of insurance and trying to compare insurance, you might put things into a decision matrix. So for low cost, high coverage, that's kind of the optimal sweet spot. This covers what you need at an affordable cost. If it is a high cost and high coverage plan, this is for people that have high risk exposure, but they need peace of mind. So it can be kind of expensive because of the high risk. If you look at the lower right-hand corner of this matrix, it's high cost and low coverage. This is where your premiums are expensive and the deductibles are really high. There tends not to be very good benefits or payouts from this type of coverage. So they tend to have poor value. And then you might think about another category of assessing insurance options as low cost and low coverage, which is only suitable for low risk individuals or temporary coverage for a very short time. So you can create your own decision matrix to compare different insurance providers with criteria and ranking systems that you define. And we put different resources in the chat on how to create that. And I'm going to hand it over to Corbin now to talk about the other things to consider with an insurance plan.
Yeah, thank you. And thanks for walking through that and talking through just this element of risk, which is a lot of this is just such a personal decision. For example, like I can choose if I want to get life insurance and put insurance on my life, and I can choose not to. It's a personal choice. Well, sometimes it's not. Like when you buy a home, your loan is likely going to make you, or your lender is likely going to make you take out insurance. When you get a car and you get a car loan, they're going to likely make you insure yourself, as well as the state has some mandatory in coverages for you to have. But this is personal in the amounts oftentimes that you want to insure your assets, your stuff, your life. And one of the biggest things that I talk about when I'm out in the field with consumers is that buying the cheapest policy or the cheapest thing is not always the cheapest solution in the long run. And that pretty much goes against every other way we act as consumers. So when I go to the store and I'm going to Jewel or Hy-Vee to get my groceries, I am going with the mindset that I want to get all of the food that I need for the cheapest cost. But when I'm looking to insure myself with health insurance or with life insurance, when I'm looking to insure my car, the cheapest thing that I can find online is not always going to lead to the cheapest outcome should something happen. Um, and so that's something just to keep in mind as we're going through this presentation, as we're creating an insurance mindset when we're looking at our assets, is we want to make sure that we are picking the policy that is best for us, not just the policy that is the lowest cost. And the second thing I hear when I'm talking with insurance, and I think it's something that is also against the grain of how we typically think of consumerism or when we're out there and we're buying things. When I buy something, when I go to Best Buy and I buy a new phone or I buy a TV, I can recognize its worth because I'm using it. Like I buy a TV, I bring it home, I turn it on, and I feel joy because I am now utilizing the thing that I just bought. Insurance, we are buying something with the hope that we aren't going to use it, except for like health insurance. Like that one we do utilize often. But for example, auto insurance, I'm buying auto insurance on my vehicle with the hope that I will never have a crash and never have to use it. And so that is kind of a mind flip for us, and it's hard for us to find the worth when it's not something we're actively using, but what we're getting, what we are actually buying is peace of mind. And I like to use this rain poncho example, and I love the picture, Andrea. And this kind of goes back to when in my work, I work at the state fair every year, and we have an agency booth. And last year, I picked for our theme was flood insurance, and we'll talk about that in a little bit. But with that, we had giveaway items, and one of those items was a poncho. And usually at the Illinois State Fair in Springfield, it's notorious that it will rain a lot, or there will be a good amount of rain. And of course, the year that I bought ponchos, it pretty much did not rain the entire time. So I had people who came up to the booth and were like, "Oh, what are these?" And I told them it was a poncho, and they were like, "Oh, well, I don't really need it. It's not raining." And I talked with them, and I was like, "Well, you can always take one." Put it in your car, put it in your glove compartment, and you never know. There may be a day when you are all dressed up for church or an interview or something, and you all of a sudden it downpours and you need to keep yourself dry going inside from your car. That's insurance. That is how we should think of insurance. It is that poncho for when we really need it. It is that thing that is providing us that protection for if something bad happens that we are not predicting. So I'd love to kick us off as we talk through insurance, just to like level playing field and talk through some of the basic terminology that you are going to come across when you are working and utilizing your insurance. And so the first thing to think through is actuaries. You may have heard of actuaries, you may be familiar, you may have never heard this term before, but actuarial science. Actuaries are people who project or calculate and project risk. They have formulas that, I'm not even going to get into how it works because I'm always amazed by it. These folks who become actuaries have to take tons of tests to become an actuary. And within the Department of Insurance, I sit right next to all the actuaries who we employ, but all insurance companies also employ actuaries. And they utilize actuaries to analyze all of the people that are pooling their money together. And through that, they're determining all of the different risks that those individuals are bringing into that pool. And from that, they can determine the amount that those people will need to pay to be insured. It's really cool math when you get into it, how it all works out. But yeah, so an actuary is determining our next vocabulary word, which is a premium. These premiums are the amounts that you're going to pay to an insurance company to be insured by them. I have multiple different types of insurance. I have an auto insurance, a health insurance, I have a life insurance, and each month I budget to give money to that company to continue to have that insurance. That amount is my premium that I'm paying for each. Whereas the other amount that we have to become familiar with when we're thinking about auto insurance, homeowners insurance, renters, health insurance is your deductible. And you're paying your monthly premium. That's the money I'm giving to the insurance company. And they're saying, cool, thank you for paying this. We're going to cover you when something bad happens. But before that coverage gets enacted, before we start doing what we say we're going to do, you're going to have to hit this amount first that you'll have to pay out of pocket should something happen. And that is called your deductible. This could range from something low to like you could have a $0 deductible on some plans. It could be $500. It just depends on the amount you set. And a good thing to remember is that the higher the deductible on a policy, the lower your premium. They are inversely related. So You're saying, hey, I'm going to take on more risk. I will pay more out of pocket should something happen. And so I'm going to pay less monthly on my premium and vice versa. And the other big amount terminology that I like to talk through when we're talking about health insurance is that out-of-pocket maximum. And this is when you have spent so much out of pocket that in that coverage year, because with health insurance, almost all of the time you're covered for a year from sign up date, that, or not from sign up date, but from a specific date when it begins. You're covered for a year. In that year, once you've hit your out of pocket, meaning you've paid a total amount, like $10,000 or however amount, whatever the amount is that your insurance company has set, after that point, everything will be covered by the insurance company. And I always put a little asterisk there because that could mean there may be a few things like prescriptions or something that's written out in the policy that is not included within the out-of-pocket maximum coverage. But on the whole, it is typically everything is being paid for by the company once you've hit that out of pocket, and it will reset along with your deductible, and you'll get a new premium amount at the beginning of the next coverage year. And then actual cash value and replacement costs. So I bring this one up. I think this is important to talk through for all the homeowners out there and the condo owners out there who, or those who want to eventually own a home or a condo. This is one of the things we get calls at the department about the most. One of the largest complaints we get in at the department is around replacement costs versus actual cash values, especially when it comes to roofing. Um, when you have a roof, you can get, and something happens, like a tornado sweeps through my neighborhood and my roof gets destroyed or really damaged. And I go to my insurance company. I said, hey, this happened. I'd like to get my roof replaced. There are two different ways that insurance company can replace my roof. One way is actual cash value, which is where I'm getting the depreciated cost from my insurance company. So, meaning that when did I get my roof replaced last? Maybe it was 15 years ago. The amount that I, in 15 years have passed with that roof until the damage happened, then I'm going to get a reimbursement from the insurance company that is the depreciated value. So it might be $4,000, as you'll see in this top row, the second cost or the second column or third column. I received that depreciated cost of 4,000, whereas with a actual or with the replacement cost or the total replacement cost, I get the full $15,000 that I had initially paid for that roof. This would be spelled out in your policy. So this will be written down whether you have an actual cash value reimbursement or a total replacement cost reimbursement. And I really urge everyone after this, if they have homeowners or condo or even renters, if you're talking about your personal property, to go look through and make sure it is the reimbursement cost that you expect it to be. So I'd love to go through with everybody and talk through some of the common coverage gaps that I see from the department, that we see across the nation, that you should be aware of as you are going out and purchasing and utilizing your insurance. So,
I got a little
oh,
excited. Sorry.
oh, oh yeah, you're fine. So I think we have a poll here. So Andrea, do you want to introduce this poll?
We do. So I just launched the poll. We want to know which of the following does not impact the cost of auto insurance. Is it your credit worthiness? Is it your driving record? Is it the color of your car? Or is it your grades? Which one of these does not impact the cost of auto insurance? So that we have 60% of you have participated so far. And people have selected from most of the options so far.
Yep.
And don't forget if there's a submit button to hit submit. I think people are changing their minds though.
Yeah. Maybe we've got them stumped.
All right. We have a lot more content to cover and we are already a half hour in. So I am going to go ahead and end the poll and share the results. And
All right.
Corbin, you want to talk about the correct answer?
Yes, so the correct answer is actually car color, which is 58% answered car color. So this is such a misconception or misinformation that's out there. Your car color does not impact your car insurance costs. So if you have a red car, drive that red car proudly. That is not going to impact the cost of your insurance. But some things that really do impact credit worthiness. So your credit score does have a large impact on your car auto insurance premium. So does your driving record. And also, a lot of folks don't know, but your grades can. So if you are a student and you are getting, typically it's a good or it's a good cause and effect. So if you are getting good grades or higher grades or have a higher GPA, you can, with many insurance companies, submit that and they may give you a discount on your premium. So something to look into. But let's talk about a little anecdote. So we often find out in the worst of situations that we have a lack of coverage or our coverage is not adequate. And my story about that is my chipped windshield. So when I go to Springfield, which I do a lot, I go about every month, I drive down I-55 and right around Chicago area in I-55, there are a lot of rock quarries, and I drive behind trucks that look like this on the highway. And these trucks are notorious for popping little pebbles onto the highway as they're driving, and those little pebbles can make some big cracks on your windshield, which has happened to me. And as a driver in Illinois in my 20s, I only got the minimum coverages that are required by the state and nothing else except for a little collision coverage. And I had no comprehensive coverage. And so it took three rocks in my windshield and full windshield replacements from Safelite Repair to find out that to really recognize the importance of having comprehensive coverage, which is the coverage on your auto insurance that covers all things that are not car wreck related. So weather, trees, rocks, pebbles hitting your windshield, all of that, you need comprehensive coverage to get replacements for your windshield, things like that. So it was a small thing. These are small. I was very lucky that it was not through a much larger devastation like my car being wrecked from a tornado, but had it was through these small little situations that I realized I had coverage gaps. And this just goes through that process of what I went through after paying out of pocket for those windshields a few times. I went, hey, you know what? I want to pay a little bit more a month to have the peace of mind to not be paying for full windshields every time I get a chip in it. So hopefully you're finding out about gaps before something happens, but these are some of those situations where you will find out about a gap.
We have
So we
another
have
poll.
another poll. So I'm curious, what do folks believe is the average cost of a funeral and burial in the United States?
We have quite the range of options on our poll so that we can kind of see where people are thinking.
Yep. All right, I see them coming in. We've got about 10 folks who have answered.
All right. I'm going to share the results.
So we're actually seeing that range. So around uh between 6,000 and 15,000 can be the cost of a funeral and a burial in the state of Illinois and across the US. And I like to just bring that up for folks because this is a gap that a lot of folks don't think about with life insurance. Life insurance covers us in our family, in our loved ones in the event of our death. And it is not just the death benefit is so important for so many reasons, but one of them is when we pass away, we want to not burden our family and our loved ones with the process of either cremating or burying us. And so that is why this life insurance can be so critical for our family. And I believe uh, with the different types of life insurance, this is just to raise some awareness. There are two main types that you're going to come and face with, and the one that we see the most often is term life insurance. If you have ever received an employee benefits package, oftentimes you'll see that term life is a part of that, that your insurance will or your work will help to subsidize, but that usually will give a 10, 20, $30,000 death benefit, which, as we talked about before, would be extremely helpful in the case of burial and cremation, and funerals. But these can also help you with life insurance can help you with providing your loved ones and family with continuity of income upon your death. So if you are a big earner within your family or you earn money for your family, it can provide continuity of income if you are no longer alive to earn that salary. It can help pay off loans. It can help pay for children to provide some income for them. So there are lots of different uses for it. Term life being you are only getting life insurance for a certain number of years, whereas whole life is it's a premium you pay for the entirety of your life, and upon your death, you will then your family would then receive in both of these situations, a death benefit. So when we're talking about gaps, some big major gaps, and I'm just thinking through all different types of insurance here, but some major gaps to be aware of: flooding, earthquakes, sewage backup. Those are not almost never covered under a homeowner's, a condo, or a renter's policy. And flooding is not just what we think, where it's like a flood is where a river overflowed. Flooding happens in in 90% or more of the state. A huge portion of this state is well, sorry, the percentage is 90% of disasters that are declared within our state of Illinois are flooding, and it's because we have such flat land and we have very wet land, and so that many times we have people calling saying that their insurance did not cover water damage from a flood. Because it is not covered under homeowners, condo, or renters. So there are separate policies you buy for that along with earthquakes, which the lower portion of Illinois is near a fault line, and earthquakes do happen. One happened recently, and sewage backup. We talked through roofing reimbursements versus with actual cash value. We talked about comprehensive auto coverage, which covers that hail damage, weather, trees, anything that's not a car collision. And then also, travel insurance doesn't commonly cover foreseeable events. So, things that when you booked your ticket, if you booked your ticket and there was already a hurricane warning that was out, things like that, but you got travel insurance, it is not going to cover the cost of your ticket reimbursement if you don't travel due to that hurricane. So, finding that sweet spot across the board, many Americans are underinsured, meaning they are lacking the full coverage they need should a disaster happen on all types of insurance. We typically are underinsuring ourselves. So it's important for us to find out what we need and see if there are things that we don't. So making sure that we analyze our assets in all those coverage buckets and making sure that we have an adequate amount we're funding those with, but in some situations, seeing where there are things we can take out, like in renters, as well as homeowners and condo, there's a coverage option for medical expenses for others. If you don't commonly host people, if you don't have others in your house that often, you may want to get rid of that one because it's not ever going to be utilized. So those are some options. All right, so insurances by strategies by life stage. Let's talk through some major life stages and when we would see insurance being utilized and purchased. So, one that I talk about very often is if you are getting a new job, sometimes those jobs would offer a benefits package. There are times when jobs do not offer a benefits package, but when they do, there could be a whole portfolio of different insurances that are offered by that employer. And within a benefits package, what an employer is doing is they're often what we call subsidizing the insurance, meaning they're helping to pay for a portion of it or a percentage of it, and you would cover the other portion of that cost. The big one that we see here, and a majority of Americans are covered through health insurance through employment benefits or an employer-sponsored health plan. So you could get offered health insurance, vision insurance, and dental insurance. You can see term life insurance being offered. You can see short-term disability. I've also seen some employers offer um, different ones like pet insurance options. So it's something to be aware of when you get a new role. You may be offered this package, and it's something you're going to want to take your time working through. Ask questions to your HR if they are, because if you are getting offered a package, your HR is often the one who have put together that package. They are the ones that would be able to help you understand it fully. Check with like health coverage, make sure and check if your doctors that you specifically go to are in network, making sure that your dentist is in network. Those are just things you want to kind of take your time and thoughtfully approach before you were to just sign up for it. Some other big time periods in which we will have changes in our insurance. I like to call out at birth. While the baby is not the one that is oftentimes thinking about insurance. I mean, it's never thinking about insurance when it is born, but something that parents should think about is that newborn babies do need insurance. And it is critical that once a baby is born, it is then needs to be transferred to become a dependent under a health insurance policy. And there is typically a deadline of a certain amount of days that parents need to do that by for that baby to then be covered under their family's health insurance policy. So that I think like I've seen like 60 days is oftentimes or to 90 sometimes is the amount of time where you need to alert your insurance that you now have a new um, baby. The when we're talking about health insurance, another big point or age to think about is the age 26 in America. When you turn 26, you are no longer able to be under your parents' health insurance plan, and you would have to purchase your own health insurance plan, either through an employer or through the marketplace, which we will talk about in a few slides, but the Illinois marketplace, which is called Get Covered Illinois. There are many options out there for health insurance, but that is something to be very aware of if you're approaching the age of 26. That is a big milestone in health insurance. When we are post-graduation or we're between jobs, there are some things to be aware of, like if you are offered insurance and as part of a benefits package, there are many employers who don't enact that coverage immediately. Sometimes there's a 3 month gap of where you have to work for 3 months at that employer before their coverage kicks in. Sometimes there, I've seen up to like 6 months or even more where you have to work with an employer before you can actually access their health coverage. Um, that's something to be aware of because you may have a large gap then where you would be lacking insurance that you would want to hop onto the marketplace, the Illinois marketplace for coverage. Or another option is COBRA, which is a federal law, and there's a state law that requires your previous employer to cover you or to you. It requires the insurance company that your previous employer used to provide coverage that you can pay for until or for a certain amount of time. So I believe it's like up to a year or more, in which you can pay for that coverage that you were receiving from your employer, your previous employer. And then finally, 65 is the other large year, the number that we want to think about in terms of Medicare. When we turn 65, we are then eligible for Medicare. We can defer Medicare for a few years if we're still working in the workforce and getting employee benefits that we like, or we want to keep the current insurance that we're on. The big thing to know with Medicare is there are penalties if you don't sign up at the right time or in time. And so there's many different parts. I'm not going to get into all the ins and outs of Medicare right now, but the Senior Health Insurance Program, or SHIP, within the Department on Aging in Illinois offers Medicare help. They have counselors and navigators who help folks sign up for Medicare and understand how those penalties work. I highly recommend checking them out.
Hey,
So,
Corbin, since
yes.
since we're going to be talking about family with young children, there was a question in the chat that I thought was timely. Can you insure a baby before they are born?
I If we're talking about the insurance of the baby, pre-insuring, so it's like the moment doing it all beforehand so that when they are born, they have coverage. I'm not sure about that process. You would need to call your insurer and work out when you would need to sign up for, how the logistics of that works with your specific insurer. When the baby is still in utero, they are they are under the mother's healthcare policy. So that, or the person that is pregnant's healthcare policy. And so it is that specific when to start the coverage for the baby would be through a conversation with the insurer.
And insurers likely differ in their processes significantly. So that's a good idea anyway.
Yes.
All right,
Yep.
back to the Corbin show.
Yeah, so families with young children, when you are family planning and when you are beginning should you choose to grow your family, there are some things to consider, like updating medical coverage immediately after a child's birth. You can take out whole life policies for your children, not covering upon your death, but for your child to have that whole life policy. You could also get term life for them, but this is something that I've heard many parents are beginning to do, taking out a whole life policy at an extremely low rate, because the younger you buy whole life insurance, the lower your monthly premium is going to be. The later you wait to buy whole life insurance, the more your premium is going to be. Parents are buying their children whole life policies so to pass on to them, they'll pay it until they're 18, the premiums, and then they'll pass it to their child. So they're just locking them in at a low rate. But also upon the death of their child, if that unfortunate event were to ever happen, there would also be a death benefit in that scenario to help cover that child's cost for burial and for the funeral. You can also get term life as a parent to cover yourself with more life insurance coverage during those critical years of your child being within your home. And so I've seen, like, I have a friend who's a pilot. He took out extra term life insurance because he just has a riskier job. He's flying planes and he wants to make sure that he has that extra amount of coverage for his family during those specific years of his child being in his home. Um, and yes, the Get Covered Illinois Marketplace. This is where you can go if you are ever in need of health insurance and you are not getting health insurance offered from an employer through a benefits package, if you are not on a spouse's insurance but you need coverage, getcoveredillinois.gov is the place for you. This is our state-based marketplace. We this is where you can go online, you can enter your income information and all of your personal information, and you can shop for a plan that best suits you based in the area that you're in. It's plans that are specific for the areas that you are in. Uh, I highly recommend checking this out. When we're talking about health insurance coverage, there are different what we call qualifying life events. There's also what we call open enrollment. Open enrollment is a time that is set every year that you can sign up for health insurance through Get Covered Illinois. Um, but also you can sign up at Get Covered Illinois if a qualifying life event has happened, which is like a marriage, a divorce, a losing a job, getting a new job. All of those big major things that happen in our lives are typically considered qualifying life events and would open up the marketplace for you to be able to buy or purchase a plan. And then outside of employer benefits, outside of all the life insurance that we've chatted through, there is homeowners, condos, and renters insurance, and there is auto insurance. These are critical. Auto insurance we'll talk about first, um, or I believe we'll talk about first, which, um, oh, renters insurance. We'll talk about renters insurance first, slash homeowners and condos. So with homeowners and with condo insurance, we can always talk about that. I could do a whole presentation on it, but typically you're getting a loan out to have your home or condo, and so you're going to be required to get homeowners or condo insurance. But why I like to really make sure folks know about renters insurance is oftentimes this is not required. My landlord actually does require it, and many are starting to. But this is the insurance that covers your stuff. And even if you're living in a dorm, you can get renters insurance if your parents' homeowners insurance isn't providing that coverage. But it's important that we cover all this stuff, all these things that we're purchasing and accumulating over time, from my TV and laptop to my bed and my books. All of that can be covered by a renter's insurance policy, but it also, what folks don't often recognize is that your renters, homeowners, and condo insurance also provides you liability insurance. Liability insurance is how I like to think about it. If someone ever sues you for something, damages that you've caused, your liability insurance kicks in and helps cover the cost of the legal cost of that process of being sued. And so this could have anything that happens in your apartment, condo, or house, or also outside of it. It follows you wherever you go. It is such critical, important insurance to have liability coverage. When we're talking about peace of mind, this is it, because if we ever unintentionally cause a damage to someone or something, that liability insurance kicks in and is there to protect you. And then with auto insurance, this one is also required in the state. We see that you have to have a liability for $25,000 bodily injury liability that is required, as well plus 50 $25,000, $50,000 based off the accident. But there's also uninsured and underinsured motorist coverage. So that's saying that, like, should someone you get in an accident and someone lacks insurance that you've hit or is underinsured that you've hit, your insurance company will help to supplement that cost. So it's greater protection for you. But all the other coverages, so collision, comprehensive, um, rental reimbursement, all of those are optional coverages for auto insurance, and I highly recommend don't just sign up for the minimums if you, or you could just sign up for the minimums, but consider your car, consider your livelihoods and all that the car is able to offer you, and if there is a need for it, you should definitely consider adding on that comprehensive coverage, that collision coverage, because at the end of the day, the state is not going to enforce you to buy coverage for your car. That's your car. You can insure it the way you want to, but it is going to make sure that you have coverage should you ever do something to someone else's car.
And I think this is our last poll. And I know that we are running a little bit behind. We're recording this, so we will make it available if you do need to hop off. But if you're going to stick with us, we just have a few more slides to get through. But this quiz that we just popped up in the poll is really to assess kind of your your risk and retirement fluency. This is something that is studied every year. It's the part of the questions that are in the PFIN index that I talked about at the beginning of the webinar. But let's just walk through these real quick. Susan worries about living a long life and running out of money. What is the best way for her to address that possibility? Is it to buy an annuity, buy life insurance? There's nothing she can do about this. What is the likelihood that a 65-year-old will eventually need some type of long-term care services? Is it about 30%, 50%, or 70%? And on average, in the United States, how long will a 65-year-old man or woman live? Is it 14 more years, 19 more years, or 24 more years? I think almost half of you have participated so far. Corbin, can you see the responses so far?
I can, yes. We're seeing, yeah, this is interesting.
Yeah, it's we've got multiple answers for each question. I'll leave it open a couple more seconds, but I'll end the poll because we need to wrap things up. And I'll share the results real quick so you can see. The first answer was buy an annuity.
Yep.
The second answer was 70%. So the very top of the options, 70% of 65-year-olds will eventually need some type of long-term care service. And then on average in the United States, a 65-year-old man or woman will live about 19 more years. So they'd be 84 if they're a man and about 87, so 22 more years if they are a woman. And I'll stop sharing and back to the Corbin Show.
Perfect. That was a good reminder to just chat through some things that you want to consider while you're approaching retirement. Medicare, as we talked about, that big number 65, we want to make sure that we're looking ahead and preparing for that Medicare enrollment. Annuities, this is like a life insurance policy that is invested and would pay you, you invest a lump sum into it and it will pay you um, monthly payments for the rest of your life or until a certain amount or until a certain age. That is something to consider, especially for folks who maybe did not do a 401k or a Roth IRA who want that monthly, consistent monthly premium or payment. Travel insurance for seniors is an option that provides a little bit extra protection than average travel insurance. And then also long-term care insurance. It is so under oftentimes we are not thinking about long-term care, and it is not known that Medicare does not cover long-term care, nor does our private health insurance. And so it is critical that we consider getting long-term care insurance to supplement that high cost of long-term care in Illinois. All right, so from the regulatory protection and consumer resources perspective, as I said, I work at the Illinois Department of Insurance. Our mission is to protect consumers by providing assistance and information, and we also regulate the insurance industry's market behavior and their financial solvency. And so we always put the consumers first, like in our definition. We are here for you. If you're ever having an issue with any type of your insurance, so this could be from auto, home, condo, pet, renters, travel, the list goes on, you name it, there's an insurance for it. If you're ever having an issue with any of your insurance policies, visit idoi.illinois.gov and you can go to file a complaint on our website, fill out and let us know everything that's happening and we will be sure to have an analyst investigate that issue for you. So that's, as I said here, you can file a complaint on an insurer. So if you're having an issue with your insurer, if you're having an issue with an insurance agent, or if you're having an insurance with the public adjuster, you can file a complaint. That case is then assigned to an analyst who is able to get documents from the insurance company, from the public adjuster. We're able to look at all sides of everything and get an answer for you as to what is going on. And sometimes we're able to reverse a decision if that is applicable in the situation. And then finally, we will follow up with you and we will let you know what's going on.
I
And
believe I
then
take back over now.
you do, you do.
All right. So just as a reminder, when it comes to your assessing your insurance needs, remember life insurance is for your family in case of your death. Health insurance covers you and any family members that you put on that plan. Property insurance, like home, vehicles, renters insurance, covers the property that you own. And disaster insurance covers your stuff in case of things like floods, earthquakes, maintenance damage, or sewer backup. So keep those things in mind when you're shopping around for insurance. You can learn more about insurance through multiple methods. We have several Get Savvy recorded webinars, not just this one that's coming up, but we have a health insurance dissected, and we have a prior cover your assets that was on insurance. It's still up if you can't wait to share with everyone you know. But we should have this particular recording up in a couple weeks. Making Sense of Money, our podcast with the Illinois Department of Insurance or Illinois Department of Financial and Professional Regulation, recently partnered with the Illinois Department of Insurance for an episode on insurance in general. And we're going to have the second part of that episode out in a couple weeks, I believe. We have also covered pet insurance on that podcast and Get Covered Illinois specifically. And we have multiple blog articles, not just one on variable insurance, which we have linked in the chat. And we will also link, we do our follow-up email to everyone that has registered with the recording once it is appropriately captioned for accessibility. And just to summarize, take a deep breath, assess your risks that you have going on, reach out to a licensed insurance agent. You can use the Illinois Department of Insurance tools to check credentials of agents that you are considering. You also want to make sure to shop around and compare services. There are some services that are going to be a little more specialized, and there's some services that are going to be a little more holistic. So you also are going to see that variance with agents themselves. Some are going to specialize in a particular type of insurance, and some are going to kind of know about everything and be licensed to sell a little bit of everything. And remember, cheapest isn't always the best. Long-term costs might be higher if you choose just the cheapest option, and that time matters. So, for example, long-term care and life insurance are cheaper when you're younger, and you're not alone. Insurance is a difficult topic, and it's okay to ask for help. And it's great that you are here with us live or listening on the follow-up webinar that we put on YouTube. If you can give us a little information about how we did today, we have a post-webinar survey that we popped into the chat, or you can look up on your phone with that QR code. Our next webinar is going to be on April 1st on student loan management, and we have a lot of changes upcoming for anyone that's going to be in school in fall of 2026. So we're going to go over quite a bit of new information in that student loan management webinar. And if you're a student loan borrower, it would be good for you to attend. You can also watch all of our previous webinars on YouTube. We have a list of all the Get Savvy webinars, as well as other videos that we have posted through the Student Money Management Center. And I want to thank all of the Get Savvy webinar series collaborators. There are many of us, and we all work together to make a comprehensive list of financial education videos and webinars available to you. And we'll stick around for questions. I think we addressed all the questions that I saw in the chat. There was one question that Corbin might be able to elaborate on. Does long-term care insurance include in-house nursing services, or is it care homes only?
You answered it right, Andrea, that it just depends, but very often we do see that there is coverage for in-home services and for memory care, assisted living, nursing homes. But like you said, it's always good to just check that specific plan. There may be differences.
Absolutely. All right. I know people need to go places, might be hungry. So thank you for joining us today. And if you have any questions later, you can email studentmoney@uillinois.edu and we will do our best to get an educated answer to you. Again, can't provide financial advice, but we can give you information to make an informed decision or know where to go to ask someone who might be more qualified to give you informed advice on that particular topic. So thank you again for joining us and sticking with us, even though we went a few minutes over, and have a great rest of your day.
Thank you.